Everybody, we're so happy to have you join us for this timely and critical conversation today. I'm Marissa Guananja, Chief Programs Officer here at the Roosevelt Institute. To kick off our time together, let me say just a little bit about the Roosevelt Institute. We are a think tank and a network of people working to bring new ideas grounded in rigorous research to conversations about how we can reimagine the rules that govern our economy, our policies, and our politics, such that we can make reality the promise of a multiracial democracy and equitable economy. The paper we just released, The Causes of and Responses to Today's Inflation by Chief Economist and Senior Fellow at the Roosevelt Institute, Joseph Stiglitz, and Program Manager for Macroeconomic Analysis at the Roosevelt Institute, Ira Regmi, is an example of this work. Inflation, as we know, has been at the center of the debates. And yet we noticed that the discourse around inflation was moving away from looking at the structural and supply side reasons that prices are rising. Our work aims to keep that analysis at the forefront of the debates. And with this nuanced understanding of what is happening and seeing recent optimism in the inflation numbers, we still see that the Federal Reserve is hawkish in its response and that the threat of a recession is still real. With this context, our work aims to provide alternative responses to inflation that address the root causes and do not exacerbate inequality. With that introduction, I'd like to kick off our program with brief introductions to our discussants. Joseph Stiglitz is an American economist and professor at Columbia University. He is also the co-chair of the high-level expert group on the measurement of economic performance and social progress at the OECD. And as chief economist and senior fellow at the Roosevelt Institute, Joe focuses on income distribution, risk, corporate governance, public policy, macroeconomics, and globalization. Ira Regmi is a program manager here at the Roosevelt Institute on our macroeconomic analysis team. In that role, Ira conducts in-depth research and data analysis and supports the think tank's work in reimagining macroeconomic policy to ensure an inclusive economy that works for all. We will kick off our conversation today by having Joe and Ida present the findings of their recent report, The Causes and Responses to Today's Inflation, which I mentioned earlier, and which again concludes that today's inflation is largely being driven by supply shocks and sectoral demand shifts, not by excess aggregate demand. Following the presentation of their findings, Felicia Wong, President and CEO of the Roosevelt Institute, will facilitate a discussion with the report authors. At Roosevelt, Felicia directs the organization's mission, vision, and strategy in pursuit of a high-care, low-carbon economy. Previously, Felicia served as the U.S. representative on the G7 Economic Resilience Panel in 2021 and served on the Biden-Harris administration Transition Advisory Board. Just a quick reminder to all, please put any questions that you have in the chat as we will be collecting them for our moderated Q&A. And with that, I'll hand it over to you, Joseph Stiglitz.
Well, thank you very much. The timing of the report obviously is very salient with the decision yesterday of the Federal Reserve to increase interest rates by 0.5%, a little bit more moderate than its 0.75%, but it announced that a resolution to continue the upward march of interest rates with a deliberate attempt to create more unemployment. We have to remember that when the average unemployment rate goes up, the unemployment rate for specific groups, the marginalized groups, often goes up in tandem with a resulting unemployment rates in particular groups of 15 to 20% or more. The thrust of the report is to say that this inflation is different from most of the other inflations that we've had in recent decades. It's not caused by an increase in aggregate demand. It is, for the most part, caused by the interruptions in supply caused by the pandemic and exacerbated by the war in Ukraine. We document this very strongly, and we counter very strongly the arguments that have been put by a few people without evidence that the underlying problem was the problem of excess spending in response to the pandemic. In particular, we show that the level of real aggregate demand has been well below potential output of the economy. It is not an excess of aggregate demand from whatever source that is the source of the inflation that we face. Not a surprise. Everybody understands what has been going on. At the early stages of the inflation, a major source of the inflation was the increase in used car prices and new car prices because of the shortage of automobiles. It wasn't like our factories were bombed. It wasn't like we forgot how to make automobiles. It was simply because they couldn't get chips. And there were supply side problems in the production of chips. It was clear that the market economy would eventually respond. We didn't know how quickly. There was a sense of, you might say, irrational optimism that these problems would be resolved quickly, because there were certain areas where supply side bottlenecks were resolved quickly. For instance, in the case of lumber, where production increased relatively quickly within a few weeks. But that was because these were uncomplicated, simple supply chain problems. But the more complicated ones, like chip, took a long time for the market to resolve, partly because the market was less resilient than we might have hoped. The fact that it was less temporary than some hope doesn't mean that the analysis that it is a supply side interruption was basically correct. It is a supply side interruption. And we see that in example after example, in the oil and in food. We know how to produce food. We've been paying our farmers not to produce food, in fact. So as we look at what has been happening in the last few months, we see the resolution of these supply side problems and prices returning to more normal levels with a disinflationary effect. We see that in oil, we see that in cars, we see it in many other dimensions of the economy. Let me digress for just a minute and talk about one aspect of the supply side, the interruptions caused by the pandemic. They caused a shift in the composition of demand. This is evident in the housing market. It wasn't like we had more Americans. It wasn't like we lost our housing stock. In fact, we had 1 million fewer Americans than we had before the pandemic because we didn't manage the pandemic very well, and immigration was reduced relative to the pre-pandemic expectations because it was a less attractive place to move. What happened was very simple. Because of the pandemic, people wanted to live in different places, and places where they wanted to move, where there was more demand, prices went up a lot, and places where people didn't want to live, prices went down, but very little. And that meant the average level of housing costs went up. But now, as we are moving into a more normal patterns, these effects are being reversed, and the data is very clear that housing costs are coming down. Maybe not as quickly as we would like, but it's clear that this is a disinflationary force at work. So what is clear in terms of policy policy has to be adapted to the source of the inflation. Raising interest rates is not going to create more chips, more oil, more food. It's not going to resolve the problems of the mismatch between where people want to live and where the housing stock is. In fact, raising interest rates may exacerbate some aspects of the problem because it will impede the investments we need to address the remaining supply side bottlenecks to construct housing where people now want to live. So, and economists have put forward other well-explored explanations of the relationships between interest rates and an exercise of one aspect of market power, of inflation, the exercise of market power. Raising interest rates tends to lead to firms with market power to raise their prices even more. So the raising of the interest rates won't solve this kind of inflation, and it may, in fact, exacerbate it. Let me make clear, too, that the labor market is not the source of the problem. Real wages have actually come down, and the most reliable symptom of a shortage of labor is tightness in the labor market, and a symptom of tightness in the labor market is that real wages should have been going up. What has been clear is that there has been a large increase in markups, a point that has been made by another Roosevelt Institute study. We don't know whether eventually those markups will come down to the trend level, and there's been a secular trend increase in markups, but with a high likelihood that they will certainly moderate from their extreme levels that they reached in the pandemic era. And if that is the case, wages can go up faster than the pre-pandemic levels without imposing inflationary pressures. To put it another way, we want real wages to recover if we're going to have a healthy economy. And we don't need high levels of unemployment for an extended period of time to engage in the disinflation, because, as I said, as the supply side shortages get addressed, that will exert disinflationary pressures results within the economy. The right response is not an unnecessary recession, an unnecessary increase in unemployment with all the suffering that goes with that. The right measure are stronger fiscal and other policies that we detail in our report. Policies to expand green energy. If there is a food shortage, reversing the policies where we've constrained our farmers not to produce and encourage them to produce more food. Other actions to encourage more entry into the labor force by providing better childcare will enable a significant new entry into the labor force. To the extent that the markups are caused by an increase in market power, and there's some evidence that that is the case, stronger antitrust action would be an important part of an anti-inflationary policy. But what should be clear is that monetary policy, an unnecessary excessive increase of interest rates, is not the solution. Normalizing interest rates was probably a good thing. The near zero interest rates that were persisted for 14 years after the 2008 financial crisis was problematic. But we now have normalized interest rates. The concern is that the Fed is going well beyond that in what seems to be a deliberate attempt to increase unnecessarily the level of unemployment in America and weaken our economy. Thank you.
Thanks, Joe. Ira, I think you have some remarks, and then hi everybody, it's Felicia Wong. And I think Ira's going to make some remarks, and then I've got some questions for Joe and Ira. Ira?
Yeah. Thank you, Felicia. Thank you, Joe, and thanks everyone for being here. I think one of the main takeaways from our paper is that we're currently faced with a problem-solution mismatch. We're trying to reduce demand. However, the problem is coming from sector-specific disturbances on the supply side. And while we make a case for all other factors that affect prices, our report also argues that a host of indicators actually don't point to aggregate demand as the culprit. Neither do cash balances, savings, or estimates of potential GDP and projections. And none of the components of aggregate demand are above trend. On the sectoral side, we discuss in the report automobile prices in 2021, energy, food, and housing prices in 2022. And now, while these are very distinct sectors, they don't operate in a vacuum and may differ in market structure, sensitivity to transmission channels, and degrees of competitiveness. And more importantly, as the paper reports, rate hikes have limited ability to affect prices of volatile fossil fuel prices that are additionally subject to the whims of powerful geopolitical forces. Our report highlights that the changes in the type or pattern of demand, such as where to live, who to live with, are more relevant in the housing sector than the overall level of housing demand. And it takes a longer time for interest rates to work through a sector that relies on long-term assets like housing. With auto prices falling over the past 3 months, we're only just starting to see what it really means for supply disruptions to stabilize. Something we incorrectly assumed happened a long time ago, even as all kinds of evidence we discuss in the report suggested otherwise. Collectively wishing a pandemic away doesn't work. It's important to not reduce this argument to something like the pandemic broke a highly functional, robust supply chain and shot up prices. The pandemic did create new vulnerabilities in our supply chain, but more importantly, exposed and aggravated existing ones. These vulnerabilities did not appear out of nowhere, but instead are the legacies of decades of neoliberalism. We have systematically disincentivized investments that would have strengthened supply chains and made them resilient. Corporations have preferred to distribute profits through buybacks instead of redirecting them towards investment. Meanwhile, aggregate markups and corporate profits have soared as markets have become increasingly concentrated. Corporations are choosing to keep prices high even as costs of production decrease. Nominal wages, on the other hand, are moderating and real wages are declining, neither of which are signs of a typical wage price spiral. The urge then to decidedly point a finger at the labor market based on previously established macroeconomic relationships that may not be as stable anymore is misguided, especially when there obviously are other pressure points that require measured interventions, quite unlike interest rates, which don't operate with that kind of precision. Besides, as Joe mentioned, we want real wages to increase. The resulting unemployment that the Fed describes as the unfortunate consequence of reducing inflation is not a nebulous cost borne by an indistinguishable group of people. The reality is that this cost will be borne primarily by Black and Brown communities, queer folks, and trans people. An unemployment rate of about 5%, for instance, when practice will translate to 10% unemployment for Black folks. This is a quintessential example of how structural racism is deeply embedded into our economic systems. Given the status of the US dollar, US domestic policies also have a large impact on the financial conditions of the rest of the world, especially developing countries with large dollar-denominated debts. plus with other central banks in other advanced economies following suit and increasing their respective interest rates, we're unlikely to see deflation in imported and tradable goods, which have been an important source of inflation. Instead, we're on the precipice of a global recession. The supposed solution of rate hikes will result in a lot of pain for a lot of people with little to no benefit. This report presents an alternative, a case for the inflationary pressures we have faced resulting from sectoral supply-side issues and the resulting changes in patterns of demand. Our solution is one of fiscal policy and other targeted measures that increase investment, curtail market power, and ensure the provision of essential services that will not only address inflation, but also provide long-term benefits to people. Thanks. Felicia, back to you.
Thank you so much, Joe and Ira. What we're going to do for the rest of this hour, I've got a few questions for both of you. And then there's lots of questions that I'm getting from the audience, which is terrific. I will try to get to as many of them as I can. And hopefully some of my questions for you will also sort of be consistent with a lot of what others in the audience want to know. So let's get to it. First question I have, especially given the Fed meeting and Jay Powell's speech yesterday, or Jay Powell's press conference yesterday, actually has, I want to dig in a little bit more on the Fed. Joe, you mentioned this slightly, but let's talk about this a little bit more. I'm interested in what you think, Joe, about the Fed's recent decisions and how you might predict their future decisions. After all, you know, the Federal Reserve, after not raising rates particularly quickly in 2021, they hiked at a very aggressive rate in 2022. I'd love you to say just a little bit more and more specifically about whether you think this actually slowed inflation. I think you have a very clear vision of that. And then I'd love to know, I mean, it's always dangerous to predict the future, but it's especially dangerous in the realm of Fed action and inflation. But I'd love you to say a little bit more about what you think might happen when we see that we know that some Fed governors are more hawkish and some are actually wanting to slow down hikes. So what do you think we can see in 2023? I'll go to you first, Joe, on this, and then Ira, you might also have thoughts on this. Joe, I think you're on mute.
So first,
there you go. Yeah.
One has to put oneself in the mindset of a central banker.
Okay.
And central bankers' main objective is controlling inflation. In the United States, we have a broader framework where they're supposed to worry about other things like financial stability, employment, growth, but when they go to Jackson Hole, when they have their meetings, what they always talk about is inflation. Now, they have legitimate concerns about a wage price spiral. Prices go up, then wages go up, then prices go up. And there are a number of economic models, very controversial, but well accepted in certain circles that are more influential in the financial markets and therefore in central banking, about expectations and expectations going up being the mechanism by which this perpetuates. One of the things that we talk about in the report is there is no evidence of a wage price spiral. Expectations are very tame, consistent with our analysis, but not consistent with this bugaboo of a wage price spiral. And part of the reason that—
Can I just ask, what would that evidence look like, Joe? Like what would you be looking for if you thought a wage price spiral were occurring?
Well, in terms of expectations, you can look at their embedded expectations when you look at what are called TIPS, the inflation protected securities, versus non-inflation protected. You can make projections about what the market thinks about inflationary expectations. And you can see they're very, very muted right now. So it's not through the expectation channel.
Yes.
And then there's another channel that used to be more important, that workers had market power and bargaining power, and they see prices going up, and they go on strike, and they say, if you don't give us wages increases, we demand it. Unfortunately, over the last 40 years, the strength of unions has come way, way down, partly to do with problems of globalization, weakening of labor laws. But whatever the force is, there is very little evidence that workers have the kind of power that they had 40 years ago. Where this shows up is the fact is that wages have not been keeping up with prices. So wages are a dampening force in the inflationary process. They've been going up. Let's be clear about that. They've been going up faster than can be sustained over the very long run. But we're not in the long run. We're in a transition period out of the pandemic and hopefully eventually out of the war. So the evidence against a wage price spiral is also coming in from another source. Not only are wages tame, but also we are seeing all kinds of slowdown in prices, in the rate of inflation. The rate of inflation has come down markedly. And those who believe in the old macro theory said the only way to bring down this kind of inflation was to have high unemployment. The fact is that the relationship between inflation and unemployment has been very unstable. It went way up with very little change in the unemployment rate from what it had been before when when inflation was stable. Why? Well, it's exactly the sectoral changes, the supply side interruptions that meant that macroeconomic relationship did not apply when you have all this stuff going on. And now we have stuff going on, undoing the stuff that went on that caused the problem. And so that same macroeconomic relationship that proved to be unstable before is now working to be unstable in our favor now. Now,
so
we can't be sure. Let me make one more point. We can't be
Yes.
sure. But one of the things we know is that monetary policy operates with long and variable legs. What does that mean? That means the full force of what we are doing today is felt 12 to 18 months later. So that means that if by the end of 2023, the Fed is anticipating raising the interest rates substantially above what they are today, the effect of that will come in at a time when clearly we won't be needing it. It's a very dangerous policy to pursue.
Right. So I was good. I'm glad you said that, because I was gonna push you just a little bit harder on this question of what you think the Fed will do, which is maybe an unfair question. So instead I'm gonna ask what you hope the Fed does. And if you could just say that really clearly, and then I'm going to go to Ira for any additional comments on this one.
Well, let me just say a little bit about what I fear that they will do, which is because in their club, the central bankers have all said, oh, we got behind the ball in not addressing inflation, when in fact it wasn't their fault. It was a supply side inflation, not a demand side inflation. One of the central messages of our paper, they're feeling guilty. I don't want to put as a psychiatrist, but they're feeling guilty, and they're feeling that they have to show their resolve, to show their masculinity and act strongly. What I hope they do is pause and realize that there is a real downside risk in what they're doing. Downside risk for America, downside risk for the global economy. And wait to see whether these forces that we say are likely to be taking place, the reversal of the disruptions that happen. And if it turns out that expectations of inflation start to increase a lot, and workers are able to increase wages much more fast, so that real wages start to increase, exceeding their pre-pandemic level, which I don't think is going to happen, then they can reassess where they are. But the likelihood is, in my judgment, my hope is, they take this pause and say, look, there's just too much uncertainty. We should not, as a matter of public policy, deliberately increase the unemployment rate faster, higher than it need to be, especially given the consequences to our society, including the growth of inequality, which is one of our major social problems.
Thanks, Joe. Ira, would you like to predict the Fed's actions or say anything about what you would like the Fed to do? Joe has suggested pause.
Yeah, I think exactly as Professor Stiglitz said, like, it's pause, stop, I think would be what all of us would hope the Fed would do. And also just like take seriously the fact that they have a dual mandate, and there's also unemployment that they are supposed to care about, and not just inflation, and actually consider the varied and long lags of the tool that they have at their disposal, and also, like, just understand and acknowledge that with financial innovation and a lot of changes in transmission channels and tools, the impact of monetary policy, what and how it can do things, has probably changed. And it's also probably not symmetrical, where increasing interest rates and decreasing interest rates have the same intensity of effect. And between the changes in the sources of financing for residential investment and strength of wealth effects and securitization, there's been a lot of changes that perhaps we need to be more cognizant of before relying on just a single tool that, as Professor Stiglitz said, like, has serious potential to do a lot of damage right now.
Can I make one more point about what relevant to what Powell said yesterday? The Fed seems to be resolved to bring the inflation rate down to 2% very quickly. Now, we have to remember that 2% number was pulled out of thin air. There's nothing magic. There's no evidence that.
But can you give us a little bit of the history of that, Joe? Because we do it. This is great because it actually addresses a question in the chat from or a question that we're getting from the audience from a reporter from the Hill who's asking whether 2% is in fact the right target or a realistic target for annual normal inflation.
There's no.
Give us a little bit of the history there. Yeah.
There's no empirical or theoretical basis of that 2%. It just became the convention. They said, what do we mean by inflation? And somebody said 2%, somebody else said 2%, and there we had it. It wasn't as if it was based on deep research that said, if you get to 3%, the economy really doesn't work well. No evidence of that kind. Now, there's some really interesting research that's come out of a whole group of economists, MIT, Chicago, that have pointed out that when you have the kind of structural shocks associated with the pandemic, the war, the oil, and all of that, 2% is not right. It's actually bad. It's not the right number.
And are you suggesting this because because conditions have changed. Was 2% ever right, or is 2?
But 2% was always a number pulled out of the thin air, had no basis. But the point is that if there are nominal rigidities in wages and prices can't fall, when you have a sectoral shock, you need to move resources from one sector to another, and having a little bit higher inflation facilitates that reallocation of resources, labor and capital, from one sector to another. So it is actually optimal to have a higher inflation rate. Now, there's nothing in the, not only is there's no magic in 2%, there's no magic in the time span to get back to 2%. So even if you believed in 2% as a magic formula, there is nothing to say we have to get back to 2% in 1 year or 4 years. So the fact that there seems to be a resolve to get back to 2% very quickly is even more unjustified than the 2% number. And that is what's causing the problem, because there are these disinflationary processes in play. They won't bring down the inflation rate to 2% overnight. We'll be clear about that. But that's not the, that is not the problem. What we're always worried about is runaway inflation. And the fact that inflation is coming down so rapidly is strong evidence that we don't have runaway inflation. We have dampening inflation. And as long as it's dampening, we are on a glide path that we should celebrate.
Well, we have more questions from our audience and guests about inflation, the risks of inflation. So I want to come back to some of those, but I also want to highlight some of what both of you have said about both the labor market, the remarkable strength of this labor market, right? With even this year, over 4 million new jobs, unemployment in ways that I think have surprised or pleasantly surprised many of us, unemployment remaining at or below 4% for a full year now. So talk a little bit about this labor market, and in particular, talk about the role that the American Rescue Plan, which was pretty aggressive 2 years ago when it was passed, but talk about the role that the American Rescue Plan actually played in strengthening this labor market. And Joe, of course, you were around and very active in policy making and or policy recommending during the Great Recession. How is this different from that experience 10 years ago? So labor market, American Rescue Plan, and differences from a decade ago. Joe?
Let me try to frame it first. The unemployment rate is not the only statistic that is relevant for describing the labor market. While we had a low unemployment rate, we also had a low employment rate. That there are a lot of people who dropped out of the labor force for a variety of reasons. Health, being afraid of the pandemic, and so forth. That meant that we had enormous scope for bringing people into the labor force, creating more jobs without putting excessive pressure on the labor market, even though the official unemployment rate was relatively low. And that's basically what's happened. We are still not back to a fully normal employment ratio. And our employment population or working age population ratio in the United States is far below that of other countries. One of the things we talk about in our report, partly because we don't have good childcare. It is strikingly lower than in countries like New Zealand. So while we were a leader at one time, we are not anywhere near that today. the American Rescue Plan was very good in sustaining aggregate demand. You know, when we went into the pandemic, there were worries that we would have a economic downturn that was worse than the Great Depression. If you look at the unemployment and how fast, how quickly we went into laying off people, it was worse in the pace than the Great Depression. So we have real concerns. Now, the American Rescue Plan did stop us from going into that Great Depression, and we should celebrate that. There are worries on some quarters that we spend too much money, and we gave money to people who really didn't need it. Well, the good news was that, you know, we had to take action quickly, and we did take action quickly. And if we had worked to fine tune it, who knows where we would have been. So the result of that is that some of the money went to people who probably didn't need it. But the good news was they didn't spend it. So we didn't have the inflation that a few people have worried about.
Yeah, that's an actually important part of the paper that, you know, you all should both speak to a little bit, even though you actually saw a significant amount of savings, especially for people in the higher income brackets, more than the common narrative would have you believe. Is that right?
Well, there was a large increase in savings. Cash balances went up in the upper half. In the bottom half, they were just struggling to get by. In the upper half, they did go up. Actually, interestingly, a very large fraction of that increase, excess savings, as it's sometimes called, came because people didn't want to spend the money like in restaurants and travel in the way they had. So actually, the pandemic spending was not the most important source of the increase in excess savings. But economic theory said that when you have that kind of excess savings, you're not going to spend it right away. Just because you hadn't gone to the restaurant in 2020 and the beginning of 2021 didn't mean you're going to make up for it by eating 4 times as much in 2022. And so economic theory predicted that you would consume out of that excess savings relatively gradually, and therefore consumption would go up only mildly. And that's where one of the things that we show in our paper, that real consumption and real aggregate demand has remained largely below the pre-pandemic trend. It didn't push us up to an inflationary. It wasn't excess demand that was the source of inflation. In fact, in the period when prices started to increase, we were still well below potential output.
Ira, anything you'd like to add to that before I go to a question? I'm going to take a little bit of a turn to go to to an international angle on this, but Ira, anything that you'd like to add to that?
Yeah, I think in the beginning, the first section of the paper, we also discuss like how there has other reasons why we think savings didn't deplete the way some of us might have thought they would deplete, and some of it also had to do with the fact that capital gains taxes increased, and we have seen a bump in the payment of non-withheld taxes, which which end up counting as a depletion of savings, but they're actually not going into consumption. They're going into payment of taxes. And the other thing also that the report talks about is logically, it makes sense that we had a huge pandemic, and people were probably wanted to be careful and cautious about how they spent the money, and there was still precarity and risks, and people chose to not just spend all of that money out. So that was just another thing.
Thank you. Yes, I definitely think that using that money to pay taxes, which is a very interesting detail in the paper, is something that folks should be aware of. It was mostly capital gains taxes, and it was mostly at the top. So that was a pretty interesting detail. Okay, I'm going to go now to a question from Jinwoo Chung, who works at Groundwork. It's addressed to you, Joe. So I will ask you this, Professor Stiglitz. What should emerging economies do as the U.S. dollar gets stronger? Should they also raise their interest rate to fight a stronger U.S. dollar, or should we pursue an alternative to U.S. dollar hegemony?
Well, it's a good question. One of the things that it brings out strongly, and that we do emphasize in our report, is that U.S. policy is causing problems for countries all over the world. That in a way, we would call it a 21st century version of beggar thy neighbor policies. Because as we raise interest rates, our exchange rate goes up. That weakens inflation in the United States, but accelerates inflation in other countries. So in a way, we are exacerbating the problems other countries face. Then many of these countries, like in Europe, face a very hard decision. If they don't raise their interest rates, their exchange rate goes down and it increases their inflation. But Europe is facing an economic downturn having to do with lots of other things, and the war in particular. But that means if they raise the interest rate, it exacerbates the recession that they face. So that will come back to bite us, because if their economy is weaker and other countries around the world are weaker, it will weaken the American economy. And that's why I said before, our policy is very dangerous. Raising interest rates is very dangerous because it reverberates around the world where their economies are not as strong as America's. And when it comes back then, as their economy slows down, our exports will slow down, and that will hurt us. Now, they face a really hard choice. I had a meeting with the head of the Bank of Japan when I was in Japan in October, and they were very brave, and they said, they bought basically the story that I told. They said, look, this is it really is foolish to raise interest rates, and they were accepting a depreciation of the yen. And it was causing a certain amount of problems in Japan, but their view was that raising interest rates would overall be the wrong decision. Europe may not feel, with the inflation as high as it is, feel that it has as much choice. And the developing emerging markets are going to be in an even more difficult position, because they are going to find themselves, some of the countries, with a debt crisis, because their debt is denominated in dollars. The value of the dollar is stronger, interest rates are higher. It's going to make it more difficult for them to pay.
Ira, anything to add? I know you think a lot about the international dimensions of all of this.
Yeah, I think it's also a lot closer to home for me, and I definitely think it's like it's probably a separate conversation that needs to be had about global debt situation and the crisis. But yeah, that's about it.
Great, thank you. There are so many questions in the chat about basically the pain that inflation causes, but I do think that you have both addressed that very directly, Because essentially what you're saying isn't that inflation isn't painful, but that there are better ways to address questions of inflation than rate raising, which was really sort of one of the major points of your paper. So I see you nodding your head, so good. I'm glad I got that right. It's 11:53. I'm going to ask each of you to make very brief closing remarks, if any, and then, as has been requested of me, I'm going to try to sum up what we talked about here, and then we'll go to close. Any last comments from you, Ira, and then I'll go to you, Joe.
I think I would definitely want to circle back to the labor market once, and I'll reassert that if you read the report in terms of looking for evidences of a wage price spiral, they're extremely dubious, and we won't really be able to point to any, but also what we call a really tight labor market right now is essentially the unemployment rate is about 1% or so higher than, it's not significantly higher at this point than pre-pandemic levels. So we need to really put this into context about where we're coming from and what we really want for the labor market.
I guess the point I'd make is that all policy is, always done under uncertainty, and one has to constantly reassess the costs, the benefits of what one does, and where we are today, where interest rates have normalized. We were in a very peculiar period of zero interest rates for a very long time. But where we are today, the question is, should we continue to raise interest rates with the intention, let me make it clear, of causing much higher unemployment? That's what the Fed is set out to do. It says it wants to increase unemployment because it believes it is the only way to tame inflation. And I think the basic analytics are wrong. I think the basic analytics are that inflation is being tamed by the natural reversal of the forces that led to it, which were the sectoral shocks, both on demand and supply side, that there are further actions that we could take on the fiscal side, on antitrust side, that would be desirable, beneficial on their own, but that the risks of further significant increases in the interest rate are very great, and the benefits at most tenuous.
Thank you to both of you. I'm going to try to do what one of our audience members has asked me to do, to try to summarize the sum total of this very wonderful last hour or last 56 minutes. For more detail, of course, folks should read the paper. And I will definitely say that the strength of this paper is the amount of empirical evidence that Ira and Joe and also Mike Hansel and others on the team here at Roosevelt have marshaled in support of this argument. Of course, this has been a debate that has been in headlines, internationally for at least the last year. And the evidence here is very clear that first, this is sectoral and not aggregate demand, meaning you have to look sector by sector at what's driving price increases. But because of that, raising rates, which is a very blunt instrument, will not help in that case. Because of this, the Fed should actually pause its rate hiking actions, partly in favor of American workers, but also because raising rates can be quite dangerous for other countries. And instead, the best policy answers here are sectoral and fiscal. So we have to look to increasing supply in particular sectors energy, and housing, and also strengthening labor policy and strengthening the power of unions, because despite a lot of the narrative, the labor market is not as, quote, hot as it's certainly a strong labor market, but it is not as frothy as the kind of common wisdom would have it. So that's what I think I heard today. That's what I'm certain the paper says. And I just wanted to thank all of you for joining us so close to the holiday season, but very, very, very timely given the Fed's recent decisions. Thank you so much for joining us, Joe, Ira, the whole team. On behalf of everybody, thank you, folks, for supporting the work of the Roosevelt Institute and for reading this very important paper. Have a wonderful afternoon.
Thank you.